Hey guys, welcome back to the Capital Mindset Show. Today we're going to be kind of doing another video like the honest video. If you haven't checked out that video, go ahead and check that video out. Tell me what you think of in the comment section of that video. Again, I asked you at the end of that video, what do you guys think about this? What are some suggestions for improvement? I will be implementing some improvements into this video because I do read everyone's comment. I try to respond to everyone's comment on top of that. But this video is going to be about PLTR. And I know I pronounce it perhaps incorrectly. I received that criticism in the past, and it's fine. It's funny because I know it's either Palantir or whatever. The point is it's the company. And I've talked about it in the past. I'll share with you that video, that older video, to kind of give you a framework. And right here, I'll actually just go ahead and share it with you guys here today. So notice that this one has actually chapters. So I want to actually make a quick comment. Sometimes I don't put chapters because you have to keep in mind that when I do produce a video, it's within the time that I have excess of my work schedule. And I do work a lot. So my work hours, I take up most of my time, and then YouTube, which is my pastime, takes up the remainder amount of my time. And I try to put I try to be as responsible as possible because I also need to sleep/eat and stuff like that. And again, this is just for fun for me. With regarding like timestamps, sometimes I have to rewatch the video, and I mean it takes sometimes depending on the video, it takes a little bit longer than not. Other times I'll just do quicker timestamps, but regardless, this one has timestamps, and I do acknowledge that timestamps help you guys a lot because every time I do them, or not every time, when I don't do them and then I do them again, I get a comment, at least one comment saying, oh yes, timestamps necessary. So with these longer videos, I'm very dedicated to put timestamps because I know that this one will be probably over an hour. So there should be timestamps in this video. Okay, so point being, at minute 16 minutes and 17 seconds of this video, on a video published on February 17th, 2022, when the stock price was about $11.77, I expressed my opinion. I talk about why sometimes later down the road, I have a hesitancy to talk about past moves because they don't necessarily provide value to the present moment. So with Palantir, it was a stock that I had sold off completely. And you can actually watch this video, and I actually show all my sales, all the sales that I did. But regardless, with Palantir, it was a position that I believed was going to be subject to kind of like liquidity crunch, and it was a liquidity boom play because I actually had shares that I bought around the IPO time. And we were entering an era where there was a liquidity boom. A lot of leverage was entering the system. The velocity of that leverage growth was increasing. And so it was a good play. It was a good play. But I made this video always after the fact, and I address it in the beginning of this video that I don't like to make videos like this. And I know some of you have asked about AbbVie, a stock position in the portfolio that I haven't done a video on. And it's because if I do a video on it now, it's only going to be the service of a case study. It doesn't actually provide any actionable knowledge at the present moment because the scenario is just different for where it is now. Now, the point of this video, again, is to look at the earnings call, earnings presentation, kind of digest the numbers, figure out what is the potential going forward. But just to revisit the conclusions at the end of this video, I stated the following, and I'll actually try to get me to say it right here. So I'll play it for you guys. Just hear it out of my own mouth. Timing the market, very silly. Psychology mistake, okay? Even though I said this liquidity crunch is happening, did I sell out of all my positions? No. I sold strategically. I sold my REITs, right? They were my tax advantage accounts. Didn't incur a single tax liability. I sold right now some of my ConocoPhillips. Didn't incur a tax liability because it was also my retirement accounts. Some of it that's still not in my tax retirement accounts, I am still probably going to sell that one. Which by the way, I've already done the videos that I've sold a decent amount of the ones in the non-tax advantage accounts as well. And so so that past Fabio, just future Fabio's kind of making some addendums to that because this was in the past, so that's already changed as well. But yeah, I'm not panic selling. So will I be buying? So also to mention, because I agree with past Fabio, I think past Fabio, that's a beautiful face. I would say that there's now been a lot more content creators talking about the liquidity crunch on this channel. You guys have been watching me for a long time. Now, we've been talking about it for a long time. And then now people are making videos about, they're calling it liquidity crisis, but I've purposely been calling it liquidity crunch, which is kind of like an out there name. And then so to kind of maintain the uniqueness of it. And that's actually what I kind of stated when I first called, or been calling it the liquidity crunch. I said that, I don't know if I'm the first one calling it this, but I'm calling it this, and it's going to be probably like unique. So liquidity crunch, liquidity crisis, a lot of people are making videos now about the liquidity crisis after the fact. So yeah, I think that, I'm patting myself on the back there, because I feel good that at the very least I got the information out there, and it's on a free platform on YouTube. So anyone could have, seen those videos. And I also I didn't stop there. I also expressed why the liquidity crunch was going to occur and how that might manifest itself within the markets, right? And so I also tried to, responsibly provide calming statements, right? Because I myself would not say sell everything now, because I don't think that's a viable strategy to success. I think that most people are going to fail in doing so, and that my strategy, and it's true, my strategy really hasn't shifted all that much. I just took away some stocks earlier, before the end of last year. I kind of took away, not most, sorry, I want to be careful with that, but a good portion of my stocks that I thought would not do as well. And so far, some of them were correct, some of them not so much. Specifically, some of the commercial REITs I had didn't go down as much as I actually expected, but we'll see. We'll see. The banks did, and Palantir did. Of course, Palantir, I was already selling out a decent amount. If you watch this video, I basically walk you through like all the times I sold and bought, etc. But regardless, at the very least, I think all the ones I sold. I'm not sure if I go over all the ones I bought. Or no, I did. Yeah, I did. I did go over the ones I bought. But yeah, that's pretty much covers that, my old thoughts. We're going to play the earnings call, and then I'll also look over the earnings presentation. I was given the suggestion that to provide what I believe might happen, or kind of give my preliminary thoughts before we get into the earnings call. My preliminary thoughts are the following. I think that we're going to see growth in commercial, growth in government, hope to see some growth in government, but I don't think the market, didn't like it, because obviously I saw the stock price, so I don't think it liked it as much as some people might think. I didn't watch anyone's videos on this, so I don't yet know what other creators think about it. But yeah, we'll see for ourselves, and I'll pause it here and there when I think there's something interesting to point out. So I also received that constructive criticism that can you please pause and talk a little bit about what it is you're writing down, or what it is that you're seeing. I'll go ahead and do that. But yeah, we'll play it here, and then we'll look at the earnings presentation as well. So let me play it. Where is it? Here we are.
Morning. Welcome to Palantir's first quarter 2022 earnings call. We'll be discussing the results announced in our press release issued prior to the market open and posted on our investor relations website. During the call, we will make statements regarding our business that may be considered forward-looking within applicable securities laws, including statements regarding our second quarter and fiscal 2022 results, management's expectations for our future financial and operational performance, and other statements regarding our plans, prospects, and expectations. These statements are not promises or guarantees and are subject to risks and uncertainties which could cause them to differ materially from actual results. Information concerning those risks is available in our earnings press release distributed prior to market open today and in our SEC filings. We undertake no obligation to update forward-looking statements except as required by law. Further, during the course of today's call, we will refer to certain adjusted financial measures. These non-GAAP financial measures should be considered in addition to, not as the genesis. Presentation. Dave Glazer, Chief Financial Officer, and Kevin Kawasaki.
Welcome to our earnings. We are in London. In past earnings calls and over the course of 2 decades, we've been involved in many of the most important things that have affected Western society. But what makes these times special is the trends that we believed would happen are happening at an accelerating rate. And what's super interesting is, why is the broader world so late in recognizing how these things are accelerating, what's happening? What is the genesis of the escapism that our broader institutions, financial, cultural, legal, technical, why are they escaping to the metaverse or faculty lounge jargon? or political structures that are clearly not solving problems, where inputs and outputs are totally anti, if at all, correlated. Why is it that we are unable to see the violence that is occurring as truly something that it will be part of our ongoing future and not as episodic? Why do we describe these things as uncertainty when they are certain and are happening? Why is it that our institutions are not even pretending that they will be able to hold the center, while simultaneously pretending the center will coagulate to a center independent of new structures, new ways of doing things, of new products, new institutions, new ideas? Part of that is we have theological structures around how we build, for example, in our space, products. And that theology presupposes that the world will be stable. So specialized things we build for both commercial and, for example, special forces, things that are powering current events now were built over the last 2 decades precisely because if you are in the periphery doing the most sensitive, important work in the world, as you need to be able to interact with your software in a way where it's disconnected and it reconnects. Simple problem. Normal software sucks at it. You need a very specialized product. We've been supplying this to the world's most important elite soldiers for nearly a decade under the context of what we call nexus peering. You need an ability to interact with space where you solve certain problems involving compute and involving the reduction of data using colloquially defined AI tuned by Foundry, getting that to the soldier. You need to be able to, in the context of commercial entities, rebuild the supply chain because there's war. There's obviously going to be food shortages. There's disruptions. You can no longer get certain resources from countries. You have to get them from others overnight. The systems literally presuppose that will never happen, and therefore fall completely apart when it does happen. There is no plan for when it doesn't happen. This is why, even though we've been a completely focused product company that is only focused on building these products, and we have new products coming and not as focused on actually convincing people that we're right, they still sell. And because the other products are not built for this world. You have a financial context, just like we have raging inflation. We are very likely to see this war increase. The risk of a nuclear event is so much higher than is being presented in the public world that it's almost surreal to watch the coverage. And yet, there's really no idea of what you would do with evaluating the quality of revenue. So that, Palantir, for example, we are a company to thrive in good times, and we thrive in bad times. We are not built in the way the theologians of our financial institutions would love us to be built, so that you're built, exactly like if we had listened to them, we would only be growth and no free cash flow. We're a company that throws off free cash flow. We're a company that expected inflation. We obviously super committed to the mission, but was obvious to us, even at inception in bad times, the quality of government revenues would be crucial because other revenues would suffer from inflation. They would have a lower quality. They'd be less sticky. We built these products for the right reasons, and we're not ashamed to say that we're winning maybe because we were right. We didn't want to be right, but some of this stuff was so obvious. It was obvious that these institutions, the theology of how we model these things in every context is just corrosive. So you end up with the wrong products, the wrong quality of revenue. So you have growth without free cash flow or free cash flow without growth. You have products that work now that can be hyped up with sales, but clearly are not going to work the day after tomorrow. No ability to build new products. Why would you build new products? You're going to have this perfectly tinkered model, get the institutions to invest in you and acquire all these companies that actually build products. Yeah, but it's nearly impossible to build products for tomorrow. There aren't companies to acquire. You actually have to do it yourself. Sure, here and there you can look for things to accelerate. Palantir has done that. So we at Palantir are not fleeing to a different world, whether it's the meta world or a theological world or a financial version of theological world or a grad school version of the theological world, which isn't even actually academic, because academic presupposes interacting with the object from a theoretical perspective differentiated from the object, not importing a theological preconceived version of an object onto the theory and re-importing that onto the object. Products don't work like that. Reality doesn't work like that. Palantir, we are playing a critical, crucial, and much bigger role than we're allowed to mention or whatever discuss in public in current events. Obviously commercially, because our partners and other future partners are being disrupted, their supply chains are disrupted, there's a threat of a disruption in the broader economy, and many realize that the reality of a truly monumental, epic, and horrific disruption in the form of a nuclear attack is much higher than is being reported. But also in the government context, where we are playing an outsized role, and we're very proud of that, and we're proud of the people we're able to support, and we're also eager to continue to help to support them. Must also say the people who've watching this, many of whom share our belief that the future is to be won by people who accept the reality of what it is and not what it ought to be, that you can only change the ought by accepting what is, that you've stuck with us and I hope will stick with us, and we are going to continue supplying the world's most important products to the most interesting, creative, and effectual people in the world, and continue to thrive as this hybrid company that is both bull and bear and comes into full stride in both environments, but in absolutely anomalous stride when times are rough and people are hiding. Palantir's products are on the absolute front line, and you see them in the news every day. And we would love someday to discuss exactly what we're doing, but we are playing a good role, and your support and buying into the world as it is enormously important to us. Thank you.
In Q1, revenue grew 31%. Commercial revenue grew 54%, accelerating for the fifth quarter in a row. U.S. commercial revenue grew 136%, also accelerating for the fifth quarter in a row. We added 40 new customers, growing customer count 86% year over year. We had GAAP operating margins of -9% versus -33% a year ago, reflecting our continued march to GAAP profitability. And we had adjusted operating margins of 26%. We have been building our company and our products for this world. The stability on which so many models that purported to explain the world rely, it's vanished, if it ever existed at all. We have built a company for the world that is, not the world that ought to be. And it is instability, not its absence, that makes our software all the more essential. As our customers confront an extraordinarily significant and rapidly escalating conflict in Eastern Europe, runaway inflation, disrupted supply chains, and a new wave of refugees, our products have become more essential than ever. At our last earnings call, the invasion of Ukraine had not yet occurred. From the moment those tanks rolled into Ukraine, we have been delivering our capabilities to the front. We have been continuously shipping innovation over the course of the conflict to provide Western militaries the software that they need to fulfill their missions. Every product and capability has been employed by our customers, from Gaia, Gotham, Edge AI, Foundry, Nexus Peering, and more. And the newest of them, Meta Constellation, continues to deliver value in making space-based collection truly operational, delivering significant mission outcomes. And we have been working across Poland, Lithuania, the UK, and other nations to power refugee relief operations. Our software is powering the World Food Programme's Ukraine response, getting aid as far east as possible. And across our commercial customers, we are powering resilience to a whole new set of supply chain shocks. Real-world events are driving enormous and long-term opportunities for growth. We are on the front lines, seeing what needs to exist, hearing from commanders and users, and building now what is needed and what will power the next decade of U.S. and allied defense programs. We did this a decade ago in Afghanistan with Nexus Peering. We did this a year ago with Meta Constellation, whose impact writes headlines in the New York Times. And we will continue building the software of the future, ramping our investment heavily across the business in the face of these Palantir-shaped macro conditions. This focus has delivered tremendous depth in our R&D and our full-stack IP. We now have this opportunity, in addition to releasing new products at pace, to bring an increasing amount of that innovation to market. And that's what you're seeing with Apollo. We believe Apollo will fundamentally change how software is deployed, anticipating a future where multi-tenant SaaS is dead and is clearly dying in the present, a trend that is accelerated by geopolitical events. Every software company will need to be able to deploy their software into their customers' environments, requiring them to manage fleets of heterogeneous environments across public clouds, on-premises, sovereign clouds, and growing data jurisdictional boundaries, and to do all of that seamlessly. Apollo will take customers from a world of continuous deployment to autonomous deployment. And we have been pleased with the market reception to Apollo in our Demo Day event, really being received by a completely new buying audience. We are also now offering Nexus Peering as a standalone capability for customers to build their own data fabrics on top of. Over a decade ago, we pioneered a technology that enabled Gotham to reason about the causality of a distributed system of many, many different Gotham nodes. These nodes could all have independent concurrent edits to the same objects, and Nexus Peering meant that we could synchronize these edits across the network, either in real time with consistent comms, as well as across unreliable, intermittent, and disconnected environments. Nexus Peering means that you have a distributed data fabric that is survivable and resilient. The loss of any number of nodes or facilities won't impact the whole. This is a core and fundamental hard technology breakthrough that has powered Gotham's unique success across coalition information sharing for defense and intelligence agencies. And by enabling Nexus Peering to be sold as a separate capability, we can enable every program in the Department of Defense to leverage this distributed data synchronization and data fabric as we further demonstrate our own commitment to DoD's modular open systems approach. The greatest opportunity for Foundry continues to be the application development infrastructure platform. We believe that Foundry will become the place that you go to build the applications of the future. With AWS or Azure, with their highly unopinionated collection of services, most of the work remains in front of you to get to value. And all of that onus is on you, the customer, to get to that value. With Foundry, you're 90% of the way there on day one. Software-defined data integration and native multi-tenancy for your applications, the OPIs, version pipelines, applications, artifacts, to just name some of the components that make Foundry work from the start. That's why U.S. Space Force's Kobayashi Maru Software Factory realized their ambition, building 13 operationally accepted applications on top of Foundry in months, while sunsetting legacy $100 million plus programs. That's why Airbus rolled out an internally developed supply chain network control tower, a suite built on top of Foundry's application development infrastructure. And this set of applications, it mitigates supply chain issues and is working towards saving hundreds of millions of euros annually by speeding up production against existing fixed capacity and reducing inventory across all parts. What AWS was in the last decade, Foundry will be in the next. Turning to the highlights in our commercial business, we added 37 net new customers in Q1. We saw continued growth in automotive, in financial services, in energy, including a new super major customer, and in life sciences. In April, we closed a renewal with a major U.S. Fortune 100 company for over $150 million. This customer hosted a hackathon with over 600 participants featuring applications built in under 4 days across finance, build planning, network resiliency, and customer experience. This was a good and telling example of how scaled customers built better on Palantir as application development infrastructure. Last quarter, we saw continued interest in our modular offerings. Hospitals need to improve operational efficiencies surrounding patient flow and staffing processes in order to decrease the length of stay and ensure patients have access to proper care. Palantir's Hospital Operations Suite has proven a unique ability to solve these problems through collaborative decision-making based on real-time data with targeted, event-driven notifications and actionable AI. Palantir's Hospital Operations Suite is now used by hospitals covering over 37,000 beds across the U.S., up from just over 1,000 on January 1st. Turning to government, as instability in the world increases, we continue to double down on our support of the missions of the West's most critical foundational institutions. Our ambition is to be the sixth prime contractor for the U.S. federal government, a trusted partner to deliver complex, end-to-end integrated hardware and software solutions, building on the legacy of programs that we prime today. But we seek to be the first company to do this as a software prime, using software innovation and our unmatched expertise to deliver new integrated hardware-software capabilities faster than the pace of conflict. In Q1, we launched our U.S. Federal Advisory Board, an important milestone in this journey. The war is not just happening on the ground in Ukraine, but also in space, and accordingly, our opportunities in the space universe continue to expand. U.S. Space Force continues to deliver new operational capabilities to America's space guardians who have set the gold standard for allies. This is leading to substantial interest in U.S. Space Force's Warp Core platform, which was built on Foundry amongst allied nations. At Space Symposium in Colorado Springs, to an audience of U.S. and allied governments, Peter Marquez, the former head of space policy at the National Security Council and the head of space policy at AWS, presented Project Argus, a new space situational awareness platform built on Foundry. We closed a £10 million enterprise expansion with the UK Royal Navy. Palantir software is used by the Royal Navy across a broad spectrum of areas, from strategic workforce planning to supply chain management. And world events have accelerated our opportunity in Western and Northern Europe. In Germany, we were awarded a framework agreement for state and federal government organizations to purchase Gotham and Foundry, with an initial order coming from the Bavarian police, adding to our existing German security customers in North Rhine-Westphalia and Hesse. Our government healthcare business grew with an expansion with the Centers for Disease Control and Prevention. The growth of the work is reflected in the doubling of the run rate. Over the past year, while continuing to deliver on the CDC's foodborne pathogen program, which we have been powering since 2009, the CDC expanded Foundry's pathogen surveillance and response work and deployed generalized modules built on top of a common Foundry ontology against new pathogens, including measles, mumps, Legionella, and novel flu. The CDC is also using Foundry to process genetic sequence data derived from wastewater samples. On the other side of the Atlantic, our continued investments in software-defined data integration with our newest Pipeline Builder product continues to pay off at the NHS, where they were able to roll out Foundry to 38 hospitals, integrating hundreds of data sets in March alone to enable them to work through the national care backlog. I'll turn it over to Dave to take us through the financials.
As Alex and Sham highlighted, we are uniquely positioned for unstable times. We work with some of the most crucial and important institutions in the world. The U.S. government was 42% of our first quarter revenue and has been a leading driver of growth for 8 years. With a 30% CAGR from 2013 to 2021, which we view as a long-term trend. More fundamentally, we believe supplying our products to the U.S. government and her allies is a core pillar of our business. As Alex mentioned, in the face of substantial macroeconomic and geopolitical challenges and uncertainty, the quality of our revenue, as viewed through growth, margin performance, and durability, and especially resilience, is unique to Palantir.
Right there, the U.S. government.
As Alex wrote in his letter, we combine the resilience of the defense industrial sector with the growth of a software company.
Okay.
In the face of our customers' challenges, we have and will continue to incur expenses prior to having contracts in the delivery of mission-critical capabilities. Following these investments, we expect acceleration of our U.S. government revenue into the second half of the year. In Q2 to date, we've already seen the re-acceleration of U.S. government revenue and expect acceleration of the overall government segment to follow in the next quarter or shortly thereafter. I'll now review our first quarter performance, followed by our outlook. First quarter revenue grew 31% year over year, ahead of our prior guidance to $446 million. Overall net dollar retention was 124%. Commercial revenue growth accelerated for the fifth consecutive quarter. First quarter commercial revenue increased 54% year over year to $205 million, up from a 47% increase in the fourth quarter. Commercial growth continues to be driven by our U.S. business, as U.S. commercial revenue growth accelerated to 136% in the first quarter, up from 132% in Q4. International commercial revenue growth accelerated in Q1 to 24% year over year, up from 22% in Q4 and 7% a year ago. Our U.S. business revenue grew 38% versus the year-ago period. Government revenue increased 16% versus the year-ago period to $242 million. Adjusted operating margin was 26%, ahead of our prior guidance by roughly 300 basis points. Our customer acquisition continues to accelerate. We added 40 net new customers in the first quarter, up from 34 in the fourth quarter. We had our strongest quarter of net commercial customer adds, adding 37 commercial net adds, which equals 25% sequential growth and 207% year-over-year growth. We expect continued growth in commercial customer acquisition throughout the year. Our growth with existing customers remains strong. Trailing 12-month revenue from our top 20 customers increased 24% year-over-year to nearly $45 million. First quarter billings were $490 million, up 35% year-over-year. First quarter ACV closed increased 35% year-over-year on the back of 208 deals versus 81 deals in the year-ago period. First quarter TCV closed was $248 million. The U.S. government's business's TCV has been impacted by the continuing resolution, but now that a new budget has been passed, we're already seeing Q2 U.S. government revenue re-accelerate. Additionally, with the geopolitical landscape outlined by Alex, we expect government bookings activity to increase for the remainder of the year, resulting in stronger government revenue growth in the second half of 2022. We ended the first quarter with $3.5 billion in total remaining deal value, up 26% year-over-year, while duration shortened 4% over the same period. We ended the first quarter with $1.2 billion in remaining performance obligations, up 86% year-over-year. As a reminder, RPO is primarily comprised of our commercial business, as it does not take into account contracts with an initial term of less than 12 months and contractual obligations that fall beyond termination for convenience clauses, both of which are common in our government business. Margins and expenses are on an adjusted basis, which excludes stock-based compensation. Adjusted gross margin was 81%. Contribution margin was 57%.
It's a real cost, stock-based.
First quarter adjusted income from operations, excluding stock-based compensation and related employer payroll taxes, was $117 million, representing an adjusted operating margin of 26%, ahead of our prior guidance of 23%. First quarter adjusted expenses were $329 million, up 7% sequentially. We are spending to position the company and our customers to win in the current geopolitical environment. These investments in product and our customers will continue over the balance of 2022. First quarter adjusted earnings per share were $0.02, which includes a negative $0.02 impact driven primarily by unrealized losses on marketable securities. We generated $35 million in cash from operations and $30 million in adjusted free cash flow. Cash flows vary quarter to quarter, but it's worth noting the $66 million increase in our accounts receivable balance. At the end of Q1, we had a very strong war chest, $2.3 billion in cash and no debt. In March, we expanded our revolving credit facility to $500 million, up from $400 million previously, and our credit facility remains entirely undrawn. Our balance sheet leaves us ideally positioned to take advantage of the opportunities that may arise from further deterioration of global conditions. Turning to our outlook, we are guiding to a base case of $470 million in revenue for Q2. There's a wide range of potential upside above our guidance, including those driven by our role in responding to developing geopolitical events. We expect second quarter adjusted operating margin of 20% in the base case as we accelerate investments to support our customers' mission in advance of anticipated contract awards and continue to expect full-year adjusted operating margin of 27%. We expect and are already seeing an acceleration of our U.S. government revenue resulting from these investments. Continuing to execute the guidance strategy set forth by our CEO, Alex Karp, in our year-end 2020 earnings call with regard to long-term revenue guidance, we are providing and will continue to provide guidance of 30% or greater revenue growth for this year and the next 3 years at each earnings call. With that, I'll turn the call over to Rodney to open up Q&A.
Thanks, Dave. Joining me for Q&A are Shyam Sankar, Dave Glazer, and Kevin Kawasaki. Shyam, this first question is for you. Kurnish P asks, are there any new products you are looking to launch in the near future?
Thank you, Kurnish. We have released so much new product. Pipeline Builder has improved data integration productivity 2 to 3x at the NHS. Autonomous sales and operation planning and execution. The Hospital Operations Suite. Meta Constellation. Edge AI and Edge Stream. And beyond new product, we are bringing to market 15 years of deep tech that we built to power Gotham and Foundry. Nexus Peering, our distributed D-Bill data fabric, is going to power the next decade of DoD programs. Apollo is going to take our customers from continuous deployment to autonomous deployment. And this is what we're focused on. Everything else, financials, performance, those are the consequences of our execution on this focus. We build software the world needs before the world knows it needs it. The prescience of our software arises from a deep love and respect for the institutions that are required for the world to function, and a deep understanding of the macro and geopolitical shifts that some might say are coming, but we would say have already arrived. And the practicality of our software arises from the deep love of our users, the humans who are at the coalface, who do the hard work day in and day out, from the factory floors of Detroit to the cold concrete floors that refugees are sleeping on in Warsaw. We build software for the world as it is today to help our customers and their humans manage to get to the world that ought to be.
Thanks, Shyam. Dave, this next question is for you. Daniel L. asks, what is Palantir doing to reduce share dilution?
Thank you, Daniel. This is actually something that is repeatedly misunderstood. If you take a look at last year, we only added 0.4% in fully diluted shares outstanding in the entire year. If you flip to the first quarter of this year, that fully diluted number actually declined for the quarter. So you literally ended Q1 with fewer shares than when it started.
Thanks, Dave. Shyam, this next question is for you. Noah A. asks, Alex Karp said bad times are good for Palantir. What is Palantir doing during this time of war, inflation, and hyperpartisanship to back up Karp's words? How is Palantir solving the world's current greatest problems?
Where's coming from?
Thanks, Noah. This question is really important. The answer to it is literally Palantir. It is the reason that we exist. As Alex has mentioned many times, we have been building our company and our products for this world. As our customers confront rapidly escalating conflict in Eastern Europe, runaway inflation, disrupted supply chains, and a new wave of refugees, our products have become more essential than ever. I've already talked about how we are helping governments respond to Russia's invasion and the resulting humanitarian disaster, from MetaConstellation and Edge AI to powering refugee and relief operations. But it's also important to understand that a chain of events has been set in motion, a Rube Goldberg-like set of bangs, boings, and ricochets that extend and will continue to extend into every facet of the world. Food is short and prices are exploding. The availability of fertilizer required to grow more food is disrupted. Commodity prices are skyrocketing. Neon gas, CF46, palladium, all disrupted, all crucial in the semiconductor supply chain. Ukraine is a major regional center for clinical trials. All of those trials and the life-saving medicines behind them are now disrupted. Simple, but essential automotive components like wiring harnesses and seat belts are disrupted. All of this is coming on the back of a set of dynamic disturbances from COVID and the resulting supply and demand shocks people are still coping with, and the emergent wave of shocks that will come from extended and severe lockdowns in China. To solve these problems, you cannot operate on software that was built to assume a stable world. In the stable world, you can make plans and you edit it occasionally. The plan is static. The assumptions are fixed and immutable. In the real world, in this world, you only make a plan so you can change it. You need all of your data ontologized into your digital twin, flowing into dynamically delivered applications that connect to each other. You need your AI to move faster than the rate of disruption. When something goes wrong, it needs to tell the person at the coalface what to do next. Inflation flowing through your supply chain means you need an entirely different approach to manage suppliers, logistics, production, and S&OP. Our work with Tyson's Foods is delivering $10 million of value realization every week by moving them from legacy approaches like integrated business planning to autonomous sales and operations execution, by moving from a static plan that was assumed to be right to autonomously planning where you go turn by turn as they are dynamically updated to navigate around unforeseen obstacles. Literally every function of every business is breaking under the stress of these events where the aftershocks are strong and more profound than the initial earthquake, and Foundry was built for this.
Thanks, Shyam. Dave, this next question is for you. Deepak C. asks, when is the company targeting to be GAAP profitable?
Thank you, Deepak. We had a negative 9% GAAP operating margin in Q1, an improvement from negative 14% in Q4, and from negative 33% in Q1 2021. So we're making significant progress. And Q1 was our strongest GAAP quarter to date. And not to mention, last year, for the full year, we posted $424 million in adjusted free cash flow with a 31% adjusted operating margin. And we're already off to a strong start this year. But with that said, we're preparing for a world that has the highest chance of a nuclear war in my lifetime, let alone since my parents are kids. And as Alex discussed, the quality of our government revenue, as viewed through growth, margin performance, durability, and resilience, is unique to Palantir. We think this uniqueness will be incredibly important in the quarters to come.
Thanks, Dave. Kevin, this next question is for you. Jackson K asks,
you didn't answer.
Can you comment on the SPAC partnership strategy and its impact on the financials?
Sure.
Did I miss it?
Revenue from these contracts has peaked in Q1.
I'm going to have to go back because I think I missed it.
$39 million.
Preparing for a world.
When is the company targeting to be GAAP profitable?
Okay. GAAP profitable.
Thank you, Deepak. We had a negative 9% GAAP operating margin in Q1.
Okay.
An improvement from negative 14% in Q4.
Okay.
And from negative 33% in Q1 2021.
Okay.
So we're making significant progress. And Q1 was our strongest GAAP quarter to date. And not to mention, last year, for the full year, we posted $424 million in adjusted free cash flow with a 31% adjusted operating margin.
Yeah.
And we're already off to a strong start this year. But with that said, we're preparing for a world that has the highest chance of a nuclear war in my lifetime, let alone since my parents are kids. And as Alex discussed, the quality of our government revenue, as viewed through growth, margin performance, durability, and resilience, is unique to Palantir. We think this uniqueness will be incredibly important in the quarters to come.
Thanks, Dave. Kevin, this next question
Didn't
is for
answer the
you.
question.
Jackson K asks, can you comment on the SPAC partnership strategy and its impact on the financials?
Sure. Thanks, Jackson. Revenue from these contracts has peaked in Q1 at around $39 million. And we will not have additional new customers from this program as we've wound the program down. Going forward, expect about $30 million of revenue per quarter from these customers. Revenue in Q1 is higher as a result of some catch-up of about $9 million recognized in the quarter, reflecting work we started last year. We also saw roughly a negative 2-cent impact on earnings per share from the marketable securities. When you look at this by geography, you'll see continued strength and growth in the U.S. business ex-SPACs, growing at 65% year over year and 9% sequentially quarter over quarter. We had our strongest quarter for winning new commercial customers overall. Commercial customer count up 25% sequentially and up 207% from a year ago. And in the United States, commercial customer count grew 368%. We expect continued growth in commercial customer acquisition, and as Alex mentioned, we see a path to double our U.S. commercial revenue again.
Great, thanks, Kevin. Sean, one more for you before we open up the call. Michael P. asks, in the FY 2021 business update, there was a reference to Ops PI as a Foundry capability or perhaps module. Could you elaborate on the problem this solves and what value it delivers to Foundry users?
Thanks, Michael. When you think about Foundry, there are really three high-level, massively differentiated capabilities. The first is that Foundry makes the marginal cost of data integration approach zero. With software-defined data integration, with pipeline builder, with all this data integration technology, we have software that writes its own data pipelines for you. This gets you to the starting line quickly. It helps you answer the question, how am I going to bring all my data together? How long is that going to take? And how do I deal with the fact that there's new types of data created every single day? The second capability is that Foundry makes the marginal cost of application development approach zero. No code, WYSIWYG application builders for robust, interconnected applications. Importantly, these are not dashboards. These are applications that read and write to your existing enterprise transactional systems, like your ERP, your general ledger, your warehouse management system. And third, Foundry has native modeling and simulation capability that lets you interact with the digital twin of your enterprise. So yes, you can compute something like an optimized production plan, but even much more importantly, you can respond to real-world surprises in real time. The best analogy I have for this is that the current technology is like most people are using something like MapQuest, where you put in a destination and then you print out the map. Foundry is like Waze, where, yeah, you put in the destination, but we are dynamically computing the best way to get there all the time, turn by turn, based on the ever-changing facts on the ground, traffic, construction, accidents, road closures. While the competition is stuck in the traffic jam, you're racing across the finish line. So all of this is possible because Foundry is a digital twin of your business, and that is powered by Foundry's ontology. So with our ontology, we're modeling not just the nouns, but also the verbs of your business, the actions that you can take. So that means you can not only realize that there's a problem with your production plan based on real-time data, but also compute the correct answer, the correct plan, and push that transaction to your ERP system. And all of that amazing capability has historically only been available for applications built inside of Foundry.
Okay, so just real quick, I just wanted to define that for everyone, because ontology is basically how you have a bunch of concepts, right? And then you can relate them to one. So it's like a domain, right? So domain, if you guys remember algebra, is the solution of all the x values. The x values are the inputs, the y values are the outputs. So you plug in an x, you get a y. So basically the ontology he's talking about with respect to Palantir is their ability to set themselves up so where you can put these inputs of the business and you can hopefully predict the output being the y value. The y value is what you really want. You want to be able to simulate things, and then you have input, output. I'm oversimplifying it there, but it's a quick way of kind of understanding that. All right, let's continue.
The OPIs, they change all of that. The power of the ontology can now be used by any application in the enterprise, whether it's first-party apps developed by IT or third-party apps developed by IT suppliers and independent software vendors. The OPIs are clean, syntactically sugary sets of RESTful APIs. I like to think about it as serverless enterprise orchestration. It's Lambda, but for your enterprise. Simple abstractions that make the authentic complexity of the real-world businesses manageable and programmable.
Thanks, Shyam. Our next question comes from Brent Thill with Jefferies. Brent, you'll receive a prompt to unmute your line and ask your question.
Regarding the government business, can you talk to the acceleration that you're seeing in the business? And I think you called out the United States as where you're seeing the reacceleration.
Some good questions, finally.
Speak to the rest of the world and what you're seeing there.
Absolutely. Thanks, Brent. We've been working with the U.S. government for 15 years, and over the last decade, we've seen a 30% CAGR, and that covers times of peace and times of conflict. And I've already talked about our involvement with current events and the role that we're playing there, and you can kind of see the reacceleration starting to happen with the wins. The work that we're doing with D6 CD2, which was literally built for a land war in Europe, the expansion of the work that we have with the UK Royal Navy, the framework agreement that we have in Germany with state and local police covering Bavaria, North Rhine-Westphalia, Hesse, the work that we're doing in space with U.S. Spacecom and Warp Core, but really the knock-on opportunities that creates for us with allies as they approach space. And so the end result of this is that in Q2, we've started to see the U.S. government business reaccelerate. We're doing a substantial amount of work right now where we are investing in our customers, and we expect that work to have both short-term but also longer-term payoffs. We're doing work now that matters and will likely be contracted, but we're also doing work that is defining the requirements for defense procurements over the decades to come here.
Thanks, Shyam. Our next question comes from Brad Zelnick with Deutsche Bank. Brad, you will receive a prompt to unmute your line and ask your question.
I'm hoping that you can. I think you guys might have cut out on me, but I wanted to double click on the range of upside that you referred to in your Q2 guidance. How much of that variability is coming from commercial versus government? And how should we think about the variability and what it means for your 30% revenue and 27% margin guide for the full year?
Thank you. So in this macro environment, we feel very well positioned for the full year and beyond. Our U.S. government revenue represented 42% of our Q1 revenue, and a significant amount of this is in the defense space. Commercial business has been outpacing the government business, accelerating in each of the last 5 quarters to a 54% growth rate in Q1. And as Shyam just mentioned, in Q2, we've already seen some reacceleration in U.S. government business, which we think is a long-term trend, and expect acceleration of the overall government segment this quarter or shortly after.
Great. Thanks, Kevin.
That's good.
Our next question comes from Mark Cash with Morningstar. Mark, you'll receive a prompt to unmute your line and ask your question.
Come on, Mark. Come on. Let's go, Mark. Let's finish this up so I can give my commentary.
Mark, you can go ahead.
Mark. Oh, Mark, man. Mark, it's a button. Press the button.
Our next question comes from Rishi Jaluria with RBC. Rishi, you can unmute your line and ask your question.
I really appreciate it. Maybe I just wanted to go a little bit more into understanding the range of outcomes in Q2. You talked about maybe where you can get a little bit more upside. Can you walk us through maybe a full set of assumptions there, and more importantly, when there's a base case and you're hinting at a bull case, what is a potential bear case that you would be thinking about in Q2, just given everything that you're seeing going on from a macro perspective?
Great question.
Look, the base case is really establishing how we're thinking about the visibility that we have. The upside is quite large. I mean, a lot of this comes down to contract timing and the acceleration of events. There's a fair amount of work that's in flight here. The way that we engage with customers is we're not going to deprive you of help in your moments of greatest need when you're at war, because paperwork isn't in yet. And so we think we have visibility into the upside. We're not going to comment on the specifics of it, but it's meaningful.
Okay.
But it's also hard to predict. And what we need to be focused on right now is just delivering, not only because of what it implies for this quarter, the next quarter, and this full year, but what it implies for the long-term growth of the business and the relevance we have to solving the most important problems in the world.
Didn't really answer the question.
Thanks, Shyam. Cool. That concludes Q&A on today's call. I'll turn the call back over to Shyam Sankar for closing remarks.
I don't need your closing remarks. All right. So kind of just some thoughts right off the bat. I kind of agree. I was just actually taking a peek at different places regarding what analysts are kind of projecting. And yeah, I kind of have I'm agreeing in this instance to not say that they're right, but I think that they have a point. I think that growth of 30% projected compound for at least 5 years is pretty feasible. I think that if you want to have a very successful investment in this, they need to grow at greater than that. But, that's kind of culminating from previous thoughts in the old video. And I think in the old video, I stated that a fair price at the time was between $7 and $5, around there. And so at the time, that drawdown was significant. Well, here we are. We're at $8 and it hit $7 for a little bit. Now, I think that $5 is perhaps a little bit of better of a price, $5 and below, but that's depending on what growth rates you're actually penciling out. Now, again, what I've been seeing is that a lot of analysts are projecting about 30%, and I actually, when I kind of run my own numbers, I think that they're probably right, that 30% is reasonable for at least the next 5 years. I do think that there's potential to accelerate. So, for example, they stated, or they were talking about, and I'll highlight this, the quality of revenue. That whole spiel in the beginning was very, philosophical. At the beginning, I was kind of like, but then I was like, okay, I got a little bit used to it. And I guess that's what we have to kind of expect from Alex Carr. That's what he's trying to project. So it's not just a company. It's also like I won't say like a lifestyle, but because that's pretty cringe. But but yeah. So that's also what they stated as far as CAGR expected to grow. They expect to grow at like 30%. United States revenue was the lion's share of government revenue. I think they stated the figure of 42%, but they do expect significant growth there. United States does spend a lot on military and defense. This is not a secret. And so a lot of it I would expect to go into more futuristic initiatives, such as kind of the new form of warfare that we can expect, such as data. Data is a new form of warfare. Well, if Palantir is really as good as people suggest or people say, then okay, I would expect that. Now, they almost try to make it sound like they had no competition. While I do say that from what I've gathered from those who work in the field, Palantir is a very strong product, but it's not the only one. And to mistake that AWS, Google, and even Azure, well, Microsoft Azure, are not working their butts off to try to make something better than Palantir is to be mistaken. And I think right now, AWS and Google are integrating Palantir into their services. And that's because they technically have a tremendous amount of control. They control the customer. So it's best that they actually integrate them for now. And as a business strategy, that's actually a good thing. And then while they can work on the back end, so they can still profit in the meantime, still provide value to their customers. And let's say Palantir is providing us tremendous amount of value. And in the back end, invest heavily in over time, actually kind of taking that out of Palantir's share. Now, remember that Palantir, as far as size goes, is a little baby ant. So, it has to be where the solutions or the value that Palantir starts to provide in their service starts to become a massive share that will then further encourage further competition. So at the present moment, there really isn't as much as a severe drive for competition as you might think. And also you got to understand that, for example, these bigger boys, right, they're investing in the whole vertical line. So they're also investing heavily in even the hardware. So the hardware that is going to be specifically designed to work with the software, which would be specifically designed to work as basically, you could say, it's a fully vertically integrated style that they're actually pushing for, and I'm saying AWS is going for it. We discussed this briefly when we talked about Intel. They are developing their own ASIC chips. Google's also doing that. We are seeing further poaching by Google from these typical legacy chip manufacturers, chip designing companies into Google to, again, develop in-house chips, because Google's idea, and Google's my largest holding, by the way, Google is basically trying to go in that direction. I can see it, and I agree with it. AWS, also, I hold AWS, well, Amazon in my portfolio as well. I have, I guess you could say, at this point, close ties with people who work at AWS, so I talk to them frequently. Well, I sort of have to, but I talk to them frequently, and I have very interesting conversations with the direction that AWS is going into, and I think that's really fantastic. Azure, don't have as much insight into that one as I would like, but I assume that the similar things, that they're working in that direction. They're really trying to improve that category of data analysis. Now, I will say that as far as data analytics goes, there is something I will kind of discuss in terms of a meta understanding that I don't think is discussed often. You have to pay attention to, and I think Palantir's doing the right thing, by the way. So are any of you familiar with certifications? And I know this is a video, so it's like weird to me ask you that question, but this is a moment of pause, reflection. So you say, what are certifications? Many of you who work in the industry will already know immediately, okay, certifications, like you get certified in some data analytics, blah, blah, blah. Well, certification is actually a precursor to growth of a certain business. So for example, Amazon, and I'll give you a little bit tidbit on Amazon's history. AWS grew when, especially really strongly, when Amazon actually began to invest in basically providing free certification to AWS products. Why did Amazon benefit from that? Well, the more employees in different enterprises that are certified in AWS, the greater the propensity for those enterprises to then rely on Amazon's services because they already know how to use it. So if I can train more and more and more and more people, and I try to make it as easy as possible for you to be trained in that, and even free, and I swallow the cost to develop that product that teaches more and more employees to be able to use my product, it increases the probability that my product then becomes more and more adopted. So Palantir, and I actually did check this because I wanted to make sure that they are pushing that initiative, and you must be making sure that if the company is serious about growth in a particular product that might be a little difficult to use, right? You must make sure that they are pushing for this, okay? So I'll tell you right now, as of January 14, 2022, Palantir introduced a certification program. So basically, in essence, what the certification program does is it helps teach employees of all walks of life basically if it's useful to what it is that you're doing, to use Palantir's products. And therefore, as Palantir does this, they can make it stickier, right? Because if I get used to using Palantir, I might like Palantir a lot. And it's like almost like advertising in a way. And think of Alteryx and Tableau. They're all doing this. Tableau, you might be a university student, and in some of your courses, you might be using one of the many data analytics platforms. Why do you think that is? Well, that's actually advertising for these data analytics platforms. Don't pay attention to that. That's very important. So Salesforce is a large enterprise, and I think a lot of universities use Tableau. And so you learn Tableau, which is owned by Salesforce. And then in that sense, when you go into the workforce, you're going to be Tableau trained, so to speak, or you're going to be used to Tableau. So then it's easier for an enterprise that uses Tableau to find talent that already uses Tableau, which in essence is like a reinforcing mechanism. So if Palantir starts to do that as well, I think that's a good strategy as well. Try to get university students to be used to your service. And so when they go into the workforce, they themselves can also kind of be familiar already with the product. They don't need as much training with the product, and they're comfortable using the product. And then that lets employers know that, okay, if I rely on Palantir, I can then, I'm comfortable with relying on Palantir because I can find talent that already knows how to use Palantir, reliably speaking. And same with Alteryx as well. So Alteryx is actually known as a low-code service, and actually from my understanding and my experience, it's very simple to use. Tableau is also pretty simple to use. If you know how to use an Excel, you know how to use Tableau. It's not that much more of a learning curve, so it's pretty good. Palantir, from my understanding, can be quite complicated. So I think that program is good. It's good for them to do. Now, don't be mistaken, and I want to be very clear. Please don't think that the other guys are not trying to compete against Palantir. And a lot of people, I think, are missing that. So again, 30% growth compounded for 5 years is what we're expecting. 42% revenue from the United States. Did you guys see that guy just completely missed or didn't want to answer the question on when they're going to achieve GAAP profitability? Now, they kept highlighting cash flows, and I want to highlight something to you guys here. Let me actually go to this. Let's go to the statement of cash flows, and these are the balance sheets, everyone. That's a joke, of course. If you guys know the origin of that joke, there you go. It's an inside joke. But here we go. So this is the statement of cash flows, and we want to go and see the stock-based compensation. So this is added back in the cash flows, making the cash flows appear positive when we remove that. Okay, and of course, well, they have this accounts receivable thing that's actually making this one a lot lower, but it's because that's not money that they receive now. That's money that's kind of owed to them. So even though it's being recognized in the income statement, they're removing it now because it's essentially not money that's received right now. So it's an asset. So we recognize it in the assets because that's money supposedly we will get in the future. Okay, so they are removing that. And it was a decent amount. So there's a lot of money just all of a sudden being owed to them, and that's a short-term asset. So that's going to be paid off throughout the year, but this is a quarterly report, so keep that in mind. But yeah, the $35 million in positive cash flow doesn't take into account the real cost. I want to be very clear with everyone. It is very real cost. We reacted to the CNBC video that was incredibly cringeworthy regarding corporate income tax, and one of the individuals, an expert, was saying that stock-based compensation is not a cost to the shareholders, implying, or the business. That's stupid. So yes, it's a real cost. It does dramatically affect the end value of the business, because if I just dilute the heck out of you, you basically are getting a smaller portion of the pie. Despite everything else being good, if my portion of the pie is reduced to nothing, then I didn't really benefit too much, even though the business might be great. So we want to watch that. We want to pay attention to that, and that is declining. Of course, you might be saying, well, that's to acquire great talent. Okay, cool. But we have to be careful how we measure that. And it becomes difficult to really measure in the real world, because how do you measure it precisely that that's being used for the perfect talent at the right time? I don't know, It's difficult. It really is. So we want to make sure that that's not going crazy. Geez, man. The entirety of the net loss. Well, let's actually see in the income statement, because I actually briefly looked at it. Where is it? Here you are. Okay, so where is it? Net loss. So net loss was 101 mil, and we see that revenue was about 446, and you saw that in their gross profit margins, right? They were showing you that net of stock-based compensation. Okay, so stock-based compensation, because that's the payment that they're providing to the engineers that are working on the product. And for my understanding, everything I've seen about Palantir, and this is from what I've researched now and before, was that they basically send an engineer to work at your company for a decent amount of time. They get to understand your company and they build it upon the foundation, which is their product, and then they basically tailor make it to your business industry. But when they already have, let's say they have an oil company that they've already built it for them, it's easier for them to then build another one for like a competitor, let's say. So if they build one for British Petroleum, they can build one for Occidental Petroleum because they're fairly similar. Of course, there'll be some changes, but it's not like building from the ground up. And so we have to kind of think about that when we're looking into the future, that as they get into different industries, to then further develop within that industry isn't as expensive, as time consuming as it was from when they were just getting into that industry. So that's going to manifest itself in some capacity in the future. To what degree is difficult to say. But, we can just go off of, for example, let's say the growth. Now, again, the management, I don't know what those questions were. They were just some like pre-prepared questions, which that was terrible. I actually would remove that, or force yourselves as a management team to do it off the cuff. Stop trying to prepare so much for those, because I did not enjoy those. I liked the analysts' questions a lot more because you didn't really have time to prepare, even though there was, I think, one question where they kind of just skipped over it. But even when the prepared question, which was hilarious, they just like kind of skipped over the GAAP profitability one. So I didn't really like that. That was really, it left a bad taste in my mouth going over that. And really, I don't know, as an investor, I wouldn't like that. I really wouldn't like that. I want like a clear answer. You don't have to be right on it, but just give me like a ballpark, like 3 to 5 years, 6 years, because that gives me an ability to kind of pencil out what I think could happen, how much I think the company's worth today. It helps a lot to know that. Okay, it's very important to me. All right, but anyways, I think that 30% growth, like I said, I'm repeating that number a lot, is like going to be the midpoint of where they grow. I think that's high probability that they grow at those rates. And we'll actually take a look at the valuation model. What I think will be the dilution rate going forward is between, and this is an estimation because they are declining, so I want to give them credit for that. But I mean, as far as you could say, let me see. Wait, let me actually get the exact number because I don't want to. Depreciation, stock-based compensation. So over the quarter, it was 150 mil. I'm going to round it to 150 mil. The market cap of the company, and let's actually pull that up. I'll get rid of. No, I'll keep that. PLTR. Can't type for anything. PLTR. So market cap's like $17 billion. So, yeah, that gives us, So approximately within the realm of about 3.5% is where I'd say that we can expect some level of dilution because of the cost for these employees, this talent, so to speak. They have a sales team that they kind of integrated more recently, and that's going to be it's more expensive sometimes when you open up a new field, because you got to attract the really high talent, and then you have to pay them up front before you can experience that benefit. Because let's say I think maybe they might have went and tried to find some of the best salespeople in the industry with track records, with a lot of experience. So those people might be a little bit more expensive, might contribute to more growth, but we'll see. So 30% mid-range for growth, 3.5% in terms of share dilution that we can kind of pencil out as an estimation. If we want to be a little bit more conservative, we can increase that to 4 to 5%. That would drastically affect the valuation, though. But let's stick to the 3.5% when we get into the valuation model. But yeah, without further ado, let's actually just hop in there. And I already kind of plugged it in, so just to save time, let me zoom in, because I know some of you watch on your phone, and it always defaults to 100%. I think 125 to 150 is the sweet spot for everyone. All right, so there we go. All right, so ignore everything for now. Let's start plugging stuff in. So 3.5, and then in the center, and we're going to say no in this instance, In the center, we're going to say the 30%. We're going to start with the 12, by the way, but I'll explain in a second. 3.5. High end, they could probably grow at a 50, which is incredible, by the way. They don't really believe that one. And actually, wait, what am I doing? This, I want to actually say yes. Okay, and then this one, this one is kind of like the next two scenarios are expecting some sort of expansion caused by, the pandemic, causing some sort of global trauma by governments and supply chains and all that stuff. So basically, I'm taking what they were saying in the beginning and how governments are going to be like, oh my gosh, we got caught with our pants off. We need to spend like a ton. So the government revenue grows a lot. And then, supply chains for private businesses were dramatically affected and their software is just so much better, blah, blah, blah. And then so the scenarios 4 and 5 reflect those scenarios. You can kind of see, by the way, and again, I recommend if you guys want to, go check out the video that's titled Why I Sold Palantir. And you can see how drastically it was overvalued at the time. Okay, at the time, how it was. And then they already achieved cash flow profitability, but the difference is we are going to include within those calculations the dilution in the terms of the fair value. So, this central point is 37, well, let's round it to 38, screw it. All right, so 38%, and that is, slightly higher, well, not slightly higher because when you compound it, but it is a bit higher than what the consensus on the growth rate is of 30, and then I then decline it to about 20% on a lower end of rounding. I'm rounding at this point. And then I think 15% is the low ball. So that's kind of like the range of prices. You can see where my prices kind of came about $5 or $7-ish. So 7 and below is where I'd be moderately interested in kind of building a position where I think that it's fair, but then that's not including a decent sized margin of safety. It's just an okay margin of safety at that point. And you have to consider the risks. The risks of competition are there. A lot of the valuation in this company, I feel, right, this is just sentiment from me, is driven because this company does get a lot of exposure. This video itself, because as the word Palantir, might get on average more views than the typical video that I do. And if you guys are, never seen this channel before, welcome. You probably clicked on it because you follow Palantir a lot. Well, here you go. So this company, quite interesting. It's not something I'd propose at work that, would be an investment idea at the present moment. If I was, for example, taking this like to that extreme of analysis, I wouldn't be risking any amount of capital right now at $8.34. I mean, if it would, it'd be like, okay, we start to nibble here. And then with the full expectation that we might receive good prices around $6 to $4, okay? And in that instance, right, we might be comfortable taking some sort of position there. But we take a look at the share dilution rate of 3.5%. If they improve upon that metric, and I'll show you, if they average it out, and this is continuous, so I might be a little bit aggressive because this is assuming continuation of it for 10 whole years. Okay, so let's say they bring that down because that's so far the trend line. They are actually bringing that down a bit. We have to just acknowledge that that's just part of doing business with acquiring quote unquote good talent. Again, we can't really measure that. We just have to trust that they are executing that well. But let's say they can bring that down to about, let's say 2%. You can see how that does affect it. And if you remove it entirely, so let's say at some point they're going to, stop it and repurchase some shares and have a net neutral effect over this time period, that does actually change the valuation prospects in that case. But you can see how severely overvalued it was. And I actually, on Strongman's Personal Finances live stream last night, I did discuss about your cost basis affecting why I might not sell even if I'm up a lot, or what would it take for me to really consider selling? And this is kind of culminating and tying back to that older video of why I sold Palantir. You can kind of see right now why at the prices where I was selling, they were severely overvalued, in my opinion. The last sale price that I did, which I started selling in the 30s, in the 30s range, the last sale, though, was still around close to $20. You can see right there, the assumption scenario 5 is still just $20, assuming 50% growth every single year for 10 whole years. Okay, so pretty crazy assumptions, but Yeah. That's basically what. And I also want to say that I'm going to actually change up some assumptions here real quick. So if I don't assume this fluctuations, and I assume this is going to be a continual process, this is basically the newer valuations, and I'm going to hopefully you guys are still with me, because I'm going to be basically going through a separate scenario right now. So then kind of explaining where my price targets before came from. So 15%, let's go to that, and then now let's plug back in the negative 3.5%. Okay, so back to this scenario. Now this is where the $5 really came from. So I'm assuming, they have a continuation from where it is today. They are able to achieve a semblance of growth around the 30% mark. And yes, and between 30% and 38% is my starting interest price of about $7 per share. That's when I say that it's interesting. So I'd say that if it gets back down to that price point, I would start to be interested in doing the same process I always do with a company like that. I'll begin the nibbling process with the full expectation that it does kind of trend downwards. And in that instance, I will build out the position more. Of course, I'll be kind of watching this company. The technology is intriguing. I'm not, you can tell that I'm not like blindly a fanboy of the company saying that the technology is, not of this earth and they can predict the future. And if you guys seen Westworld season 3, there's a orb in that show where the orb is like this AI. And I think people have this kind of sentiment that Palantir is that orb that predicts everything and then runs the world and stuff, and that Palantir will be that. Well, I don't necessarily think that that's the case. I think that it's a very advanced data analytics platform, but that there is competition that will come into play in the future. And I think that competition will come in the form of, AWS's own integrated solutions, Azure maybe, and Google for sure. So Google, I'm 100% for sure will be going into that field. AWS, yeah, but for now they're partnering with Palantir because it's the pathway of least resistance. And so, yeah. So that kind of summarizes my thoughts on Palantir. My thoughts really haven't changed. We are at much better price points today because at the older video, just to remind myself, the older video was like $11.77. Today, well, as of close of Friday, it's at $8.34. It briefly touched around $7-ish. And I mean, well, I'll save it for the update video because I'm trying to keep the content separated. But on the update video for the portfolio update, there's some more discussion I probably will have. So I'm just discussing strategy in this video. So yeah, strategy is around $7-ish, just like the other video. Would be the point where I start the nibble process with the full expectation again that I might get better prices. And yeah, we'll see what happens. So on that note, guys, thank you guys so much for watching. If you guys have, again, any other forms of criticism, concerns, or anything, leave it down in the comment section below. Let me know if this style of video, again, is what you like. We do listen to the earnings call. I was trying to get some words in, but I didn't want to pause them and kind of cut them off. I wanted to give them the chance to maybe respond. We did know, well, I guess now that analyst who didn't even answer, his freaking phone, will now be like a funny meme from this video. That would be the comedic moment within the boring boringness of it. But yeah, I thought, again, earnings call was meh. Information was meh. I didn't really learn much except for when the analysts provided some good questions. They actually asked good questions. I don't know where the other questions were coming from. Well, it's not that those questions were bad. Their answers were bad, really bad, because they were pre-prepared. And like the Gap one, I had to rewatch because I was like, did I miss the answer? No, he just didn't answer the question. So the reason why it's important, and I'll leave you guys with this, the reason why Gap net income is important in particular, and again, investing is nuanced, is because we want to make sure that they can achieve a semblance of profitability, even when assuming the very real cost of share dilution. Very real cost of share dilution. Let me say that again. The very real cost of share dilution. It's very important, okay? Because it is a cost to you. You are paying it. If you're a shareholder, you're paying that. That's a cost to you. Please, that is a cost to you. All right. So with that, I'll leave you guys off on that note. And yeah, so I'll see you guys on the next one. Bye.